Most of us have heard the term tax shelter feature of real estate, and it's confusing to understand what people mean when they say tax shelter feature of real estate. What they're really talking about is depreciation. And depreciation is a concept of the tax law. What the concept of depreciation says is that when you use and enjoy an asset, you're using up its value. The value of the asset is going away, and therefore you get to write off the value of that asset over a set period of time that's established by the tax code. It's sort of a fiction of the tax code, because with real estate, we find that in reality, over time, real estate tends to appreciate in value. But again, this is a tax concept. It's statutory. It's created in the tax code. So don't focus too hard on trying to make sense of the whys of depreciation. But let me show you how it works. The IRS, Internal Revenue Service, establishes a useful life for each type of asset. Residential real estate is said to have a life of 27.5 years. Wow, that seems a little strange. 27 and a half years? Where'd that come from? Well, think about where these rules are made in Congress. How do we make decisions in Congress? Half the folks thought it should be 25 years, half thought it should be 30 years, so they compromised. These laws were passed back when Congress used to actually do something. Why 27 and a half years? Well, as I say, it's not going to make a lot of sense. It's statutory. It's decided by Congress. It's part of the tax code. And one of the examples of why it doesn't make a lot of sense is you could go out and buy a brand new house, and I could go out and buy a 100-year-old house, and according to the tax code, they both have a life of 27 and a half years. And it's different with commercial property as opposed to residential. If I had $100,000 to invest in residential real estate, I would take depreciation or write off the assets that I purchased over 27 and a half years. If I took the same $100,000 and put it to work in commercial real estate instead of residential, the lifetime is 39 years. I have to write it off over a longer period of time. I don't get as big a deduction, as big a tax benefit on an annual basis just because it's commercial real estate instead of residential. Let's look at how a specific example would work. The first thing you need to know is that we only depreciate the structure. We buy a single family home, there's the structure, and then there's the land that it's sitting on. So we only depreciate the structure, not the land. The theory behind that is that land doesn't wear out. Think of the loss in a fire, for example. You could have a home that burns completely to the ground, but the lot's still there and it can be built on again. So we don't depreciate the land because land doesn't wear out. Now, when we take depreciation, it's the purchase price and the closing costs. It's the total cost of acquisition. When you buy real estate, there are always some closing costs associated. You take both of those numbers and add them together to give you our acquisition cost. And you have to allocate the purchase price between the structure value and the land. Then, once we've sorted out how much is structure value, we divide that by 27 and a half years, and that gives us our annual depreciation deduction. Let's look at some real numbers. Let's say that you and I go out today and we buy a property for $285,000. And associated with that purchase, we have closing costs of $4,000. Let's assume that the land makes up 20% of the whole package. And quite frankly, that's a convention that realtors and CPAs and investment counselors use, is unless it's an unusual situation, they're going to assume that the land is 20% of the total purchase price. Now, if we were in Texas and you had 200 acres with a little cabin on it, that wouldn't make any sense. But in our market, that's widely accepted as the rule of thumb. 80% of acquisition costs are for the structure and 20% for the land. So if we take our purchase price plus our closing costs, that gives us $289,000 in total acquisition cost. There's a buzzword for you. We take that 289 times 80% to come up with the structure value. 231,200 is the structure value. It's 80% of the total acquisition cost. That's also called the depreciable amount. And we take that number and divide it by 27.5 years, the life of the asset as dictated by the Internal Revenue Service and the tax code. And that results in a deduction of $8,407 each year that we own the property. We're getting to take a deduction even though we didn't write anybody a check. And that's going to result in us having more write-offs sometimes than we have revenue, and it saves us from paying taxes that we would otherwise pay. Now, it's not a total freebie because the government keeps track of the depreciation that we take, and at the time that we sell, we have to recapture some of that. But let's work through our example. So we get a deduction every year of $8,407, but we don't write anyone a check for it. And I mentioned that it's not totally a freebie because the depreciation that we take lowers our basis in the property. When we purchase a property, that total acquisition cost, the purchase price plus the closing costs, that's our initial basis or our acquisition basis. When we take depreciation, we get that write-off in the current year, but the way the government keeps track of it is it reduces our basis. In the example we're looking at, our acquisition basis, our total cost of acquisition, was $289,000. In the very first year, we're going to write off or deduct on our tax return $8,407 for depreciation, even though we didn't write anybody a check for that. And they keep up with that by making us, on our tax return, lower our basis by that amount, showing at the end of the first year that our adjusted basis is now $280,593. And that happens every year. You have to take depreciation, it's not optional, and it lowers your basis. Well, if the basis meter can turn backwards, if it can get smaller because of depreciation, is there anything that would roll our basis forward or make our basis bigger? And yes, there is something. Capital expenditures increase our basis. For example, if this house didn't have a deck and we added a deck, then the cost of that deck would increase our basis. The depreciation lowers basis, capital expenditures increase basis. The benefit of depreciation is that it gives us a deduction that we didn't actually write a check for, and that in effect shelters the income to the extent that we have depreciation. If you'd like to learn more about investing in real estate, I invite you to give us a call, stop by our office, or check us out on the web at www.blockrealty.com.